The summers might be heating up, but the winds of the housing market are still chilly. Tight inventory, ridiculously high house prices, and elevated mortgage rates, a trifecta of headwinds, are brewing an affordability crisis for buyers. At the same time, a fear of impending increase in inflation lurks in the air. Like every other market in the world, boom and bust are the parts of the game. It is a factual reality that all things have a tendency to revert to the average, and this housing bubble will be no different. Based on the numbers from the past, this is one of the biggest boom eras in economic history. A trajectory towards the long-term average becomes more and more inevitable as the numbers continue to increase like this. So, the real question is, how far do we have to go? While predicting a real estate market crash might be difficult, analyzing market trends can provide us with various valuable insights. Currently, an atmosphere of uncertainty obviously permeates the market. Not only the home buyers, but even the homeowners and prospective sellers are feeling nervous now. Please support our channel with a thumbs up and don't forget to subscribe to our channel. Data charts by the National Association of Realtors have officially indicated a negative growth rate in realtors. We have finally started witnessing the signs of the much talked about recession in the U.S. housing market. But why are the sellers quitting? The answer lies in the correlation between house prices and the realtor growth rate, which is a straightforward connection. Realtors tend to follow price trends, and the real estate prices, after experiencing a period of rapid appreciation in the last few years, have now started to decelerate. With more than a 3.5% decrease in realtors every year, California is the state where sellers are quitting in masses. These numbers provided by the National Association of Realtors are the highest in America currently. The decline does not seem like a mystery when you look at the data points provided by Redfin. In Oakland, the prices have gone down by 16% per year, 13% in San Francisco, 10% in Anaheim, 9% in Oxnard, 10% in Sacramento, and 8% in LA. If you compound this price crash with the sales crash, the decline in average commission becomes clear, and the situation becomes pretty self-explanatory. In the Bay Area, an average seller is earning 49% fewer commissions today than a year ago. A realtor in Los Angeles stands on a negative 38%, and the markets of Seattle, Phoenix, and Vegas are down by 30 to 40%. Based on the recent home prices and sales activity, did you know that an average seller in America earns $58,000 per year in commissions? It is well below the long-term average and way below the good times sellers saw in the pre-pandemic era, with an average of $95,000 commissions per year. Considering the present situation, we might see part-time real estate sellers withdraw first, and then the full-time earners drop off next. In the coming 3 to 4 years, we can witness a 30% reduction in the number of realtors in the U.S. Remember the national 30-year mortgage rate that decreased by 8 basic points in June? It has ticked up again and now sits at almost 6.8%. As reported by News Daily, we can anticipate it to rise to 7 or above, which would deal a significant blow to an already struggling market. By combining these mortgage rates with today's housing prices, the total monthly cost reaches an all-time high of $3,000, encompassing mortgage interest, taxes, insurance, and maintenance. This cost for an average home buyer not only surpasses its long-term mean, but also significantly exceeds the median cost to rent in America. In Dallas, the cost to rent an apartment is almost $1,800 per month, 51% less than the average cost to buy a house. Likewise, a home buyer in Seattle has to pay $4,400 per month compared to a $2,200 cost to rent. In Denver, the cost to buy is on average $3,500 per month, whereas the cost to rent is around $2,000. To determine whether it is a favorable time to buy a house, it is essential to compare the rental prices with the buying costs. In Austin, Texas, the average cost to buy is $3,500, and despite the recent decline in the market, it's still double the cost of renting. The same trend can be observed in Salt Lake City, with $3,200 versus $1,700 buying to rent cost ratio. The rents in Boston might be as expensive as $2,900 per month, yet they are cheaper than it takes to buy a house there, which is on average $4,100. The situation in New York is no different, where it takes $4,000 on average dollars to buy a house and $3,100 to rent an apartment. As long as we see such a huge disparity between the cost to buy and the cost to rent, any meaningful recovery in home buyer demand is hard to anticipate. The constraint in demand is expected to put a further strain on the home sellers who are being stubborn about their home prices. All of them have listed their properties too high or not at all. They might be doing this with the assumption that buyer demands will increase and pull the mortgage rates down, but that does not seem likely to happen. Ultimately, they will be forced to cut down the prices because the current housing market does not make sense to an average home buyer right now. Throughout the history of the United States, such a difference between rental and home ownership costs has never been able to sustain itself. It is likely that this trend will continue into the future. Usually, one of these two things happen. First, the cost to buy goes down with lower mortgage rates and home prices fall as well with rent prices. Or second, the cost of rent rises to meet the buying costs. If we analyze the May 2023's rent report by Rent.com, we can see that the rents in the U.S. have been flat and moving towards a decline. In the markets like New Orleans, Austin, Phoenix, Vegas, Oklahoma, Chicago, Birmingham, Memphis, Sacramento, and Seattle, the rents have seen the biggest decline. The reason is those record high 1 million new multifamily units and apartments that are expected to make it to the market in the coming years. Considering this number, the rents are likely to stay flat or decline even further in the coming years. This discord between rental prices and purchase costs can only resolve itself by pulling home prices down. Moreover, home prices cannot sustain continuous growth as long as the Federal Reserve Bank remains steadfast in its agenda of lowering inflation. We might have to stick to the facts and figures to see how the economy plays that out. Now, why do you still see open houses and bidding wars if the downturn is worse than before and realtors withdrawing in droves? The answer is everything to do with the housing supply or the inventory. With stats by Realtor.com, there are 560,000 homes in the real estate market for sale today. The number is almost half less than the inventory in the pre-pandemic era. The restricted inventory has created competition and a perception that the market is still buoyant. So, is the affordability crisis ever going to resolve itself? We need 500,000 more houses in the real estate inventory for meaningful affordability relief. There are 12 million homes lying vacant. If only 5% of those vacant homes go on sale, we would have the inventory we need. Moreover, there are 50 million mortgage holders in America. If even 1% of them are foreclosed on by default or forced to sell, the inventory will go up. In simpler words, there has to be selling pressure for the inventory to rise in the current real estate market. The problem is if they sell, where are they going to move to? And why would they want to sell and get into another mortgage with much higher interest rates? Today, every 1 out of 10 houses sold is bought by investors that operate under a different psychology than a typical buyer. They are more likely to dump inventory and get out only when the market worsens. Although the investments have slowed, these individuals have not yet started panic selling. Given the current economic situation and lurking fear of inflation, liquidity needs might be a problem for many owners. It is just a matter of time before they will be compelled to sell in a declining market. Consequently, the prices will substantially decline. A lot of people have been waiting for that, and it gets frustrating, but you have to be patient as housing downturns can take time to play out. For instance, the downturn in the late 2000s that everyone says was so obvious was not so obvious back then. In 2007, right before it occurred, many realtors and investors believed that the market was not going to crash anytime soon. The prices were going down by 1.4% per year, which they considered no big deal, but actually, it was a big deal because the prices did not recover for another 4 to 5 years, and realtors started quitting by the thousands. Similarly, the downturn of the 90s was also not foreseen. Although it was not a full-scale national crash, the housing prices in overvalued markets did decline significantly and kept decreasing for 6 years. We might still have a long way to go before experiencing a market crash, wherein both sales activity and prices recede. Thanks for watching. Please like, subscribe, and comment below, and watch this one as well.